All right, Wall Street Yardie here. I'm bringing you today GitLab Inc. or GTLB. We're looking at the one-day candlestick chart here, and this one popped on my scanner because it closed above the 200-day moving average with high volume. So those are two things we love to see here as the price is reversing from being under the 200 for a long time here, as you can see on the chart. We're now reversing, closing above the 200, got a lot of volume. When we see big volume, as we always talk about here on the channel, that's a sign of momentum to the upside. So that's what we're looking at here to play GitLab all the way up to the levels here that we're about to find. And then I'm going to walk you through a couple strategies on how you might want to play it if you're using stocks. One, when you're using options for a small account, and then another one if you have a little larger account and can do some more long-term type leap investing with options as well. And then we're going to get into, of course, as always, we're going to do the technical analysis, find our levels, know where we're getting out, and create a plan for this trade. First thing we want to do is we need to go and find where this thing can go to, right? We see here, looking at the daily chart, GitLab looked like it was going kind of sideways here, and then it took a big dip somewhere towards the end of last year. It started trending sideways here, and now we're starting to see higher lows, and we're also seeing higher highs. So that's how we know the trend to the upside is forming. In conjunction with our candle today that closed above the 200 and the high volume, put those together, and we're starting to see momentum. I also then look at my moving averages, right? So my 20-day moving average, which is my yellow line here, is also sloping up. Had a nice big slope up here, went flat, and now it's starting to slope up again as we're crossing the 200. The 50-day reversed and is also sloping up. So these two are going in the right direction now. They're also in order, right? So the 20 is above the 50. That's what we like to see. That is also indicating that there is an upward trend forming here. So we need to find some levels. We need to know what our target or take profit targets are. So we need to drop some lines on the chart. And as we always do, we go to our handy dandy Fibonacci retracement. I don't use the Fibonacci retracement as a place for reversal. We use it more to find our support and resistance. So we always start with whatever's chart. We're looking at a 1-year candlestick chart here. So I always go to the high, and then I find the low on the chart for the 1 year. And then we'll adjust this to see. All right, so let's go through and see if these levels are matching up to our candles here. So we'll start down here. Some good touches here. Little breach there, little breach there. Just a couple misses here, some misses here. So let's take a look here where a lot of the chatter is actually up here back in late last year. We're doing some misses here. And what I notice is that this high had a big long candle on top, and there's a lot of action here just below it. So I'm going to pull my Fibonacci down a little bit to match up with these candles and see if that gets us a little better. If I look at the low, there's a similar situation there. So I'll pull that one up just to touch the body of that low candle there. So that will set our things. Let's see if we get a little better, a lot more better touches here. So we're looking good. We know we anchored to that, so that's good. And now we're touching on these extremes and multiple touches here, multiple touches here. So these lines are looking good to me, and I'm going to start using those. So let's turn off our moving averages, first of all, just to clean things up a little bit. That makes it a lot easier to see. As you can see here, we get some really, really good touches at this level. So let's mark that one up. We're going to mark that 44, we'll call that one 44.50-ish, right? Just to have a nice round number. We'll then also take a look here. We're getting pretty close in here. We'll just go ahead and drop this one here. We'll call this one 39, right? Just to kind of be in a nice round number area here as well. So that's 2 levels above. Let's try to find 2 levels below. I like this little pivot low here. So it's a little close here to this 26.88. Remember, support and resistance is always an area, not necessarily a point. So we just want to get close. So I'll drop that there. Let's call this one 26.50, right? Just to have a nice round level there. I guess it's a nice little area here, right? Including this little breach below. And then we'll just tap to the low here for our second one to the bottom side. So those are our candles here. Now, what I did notice, and we kind of pointed this out, is we were trending sideways here early last year and then dropped. So we need to kind of figure out also what was happening before. One last line I'll drop, of course, is up here at the highs so that we know that's kind of our ultimate highs. But going back to my point is that We had a lot of trending sideways here, so I'm not sure where this is coming from. And I could start scrolling left, but the easier way to do this is to just switch over to the weekly candlestick chart. Looking at the weekly now, we see, oh wow, GitLab IPO back November 2021, and then it dropped in a big way, and then just started trending sideways here in this range. So we see here that there's a lot of activity right at this 5130 level that we marked up, which was the high on our daily chart. So we know that that is probably our ultimate target for right now. There are some highs above that we can, target with some trailing positions. But for now, what we want to do is really just pay attention to kind of where we're going from where we currently are, right? So we're currently sitting at about 33.86 was the close from the previous day. And right now we are in the pre-market opening at 34.30. So we're about, a few cents higher in the morning here as before we open. So my first target to the upside is 39. So if you want to play a quick one, we might want to look at the 39 as your exit if you want to do this as a short-term trade. For those that have been following the channel, this is one of my favorite trades. So switching back to the daily, whenever price crosses over to 200, we get explosive moves. We had this in F-Cell, we had this in N phase, and then there have been several other trades throughout the year that we've had this kind of pattern where price is underneath the 200, it crosses the 200 with momentum, and then we take off. This is a really good sign of a breakout. So I'm actually paying attention to 44.50, maybe that 51 level, right? But 44.50 is probably the first place I'm looking to maybe take some profits if there's a pullback here, right? Or if price kind of slows down and just kind of starts trickling and starts pulling back towards this 39 level. So that'll be the first place I might pay attention to as a first exit, given the history of this type of trade. And then there's also the 51, which is kind of my ultimate. Okay, we get there and I'm pretty much done. But we'll talk about sizing and the trades here right now. One thing to note real quickly before we jump over to the option chain to find a way to play this is that we have earnings here September. The earnings are not going to be until September 8th. So we have quite a bit of time. So we'll keep that in the back of our mind for our shorter term trades on our option side. Now, if you're trading this as just stock, right, this is cheap enough for most to be able to trade as a stock. We have a $34 price here that we have playing with. So like I said, if you're buying stock, you could play this up to 39, 44, wherever you feel comfortable. As we get up here and if price does break through 39 very quickly, I would look to set my stop loss somewhere here inside of this gap. So let's drop this gap on the chart. As we know, gaps play support and resistance as well. So we do have to watch this area not only as a place to set our stop if we break through 39, but also if price doesn't continue here and reverses early, that could be a sign that this move is not happening the way we expect it to. So we're going to pay very close attention to that gap here, call it 36.51, and see what happens. But if we break through 39, say you bought the stock, you break through 39, we have some strong candles here, and price just kind of starts going sideways as it normally would. That's the proper way stocks tend to move. They move up in a big way, move sideways, pause for a little bit, and then goes up to the next target. Now, this is a momentum play. So we're looking at the breakout. We already have high volume here. If you look back from the last earnings, they had high volume for 3 days in a row here, and the price kept pushing all the way into earnings, and that's when it pulled back. So now we're seeing that momentum start to form again. So if you're buying the stock, look at 39 maybe as your first target. Maybe you take half off, take some profits, or if you don't take any off, then it goes up, and then use this 36.51, which is this gap support level. If price closes below this, not if it just breaks, but if it closes below this, then that might be a place to say, okay, that's my stop. It's not going to go any further. At that point, you would take some profits and have a nice little return on the trade as well. All right, so let's jump over to the option chain now, and we're going to talk about the first one as a small account trader and how you might be able to play it. Switching over to the option chain now, taking a look here at Thinkorswim with the GitLab ticker up, and we're going to see the option chain here. Now, the first trade I want to walk through is one for a small account. I define a small account as anything under $10,000. What we're going to do is look at buying maybe just a straight call given that our upside to GitLab was right there at that $50 level, we might want to, not necessarily take a long-term view on this one. GitLab is a stock that's never actually had positive earnings, so they're not a profitable company. It's not something you might want to hold long-term, right? So we're just going to play this as a trade, and one way to do that is by buying a call option on the stock. So whenever I buy call options, I like to look at 45 to 60 days out, which looking at the option chain here, that puts us out maybe right around this August expiration time frame. The yellow ones here are weekly expirations. I don't necessarily like to buy those. They're not as liquid, so it's not going to be easy to get in and out of those. But the August time frame fits right on the short side of our 45 to 62 day kind of expiration. Unfortunately, the September goes out to 70. That might be a little long, but we could take a look at those too. It really is going to depend on kind of how much these call options cost, and then kind of what our account size is and if it will fit inside of our account size. So to size these, I would like to stay under 5% of my account. So, with a $10,000 account, that means a $500 risk. So I want to find an option that's going to be less than $500. And then that might be something I can play. So let's open up the August option chain here. I'm going to focus on the calls because we're looking to the upside. Remember, calls are, if we want to speculate if the stock is going to go up. So that's why we're going to look at that. So looking at the option chain here, I see a lot of options here under the $5 mark, right? So remember, each option contract is 100. Well, the way it shows on the chain here is per share. So you always have to multiply this number by 100. So we're looking here, I could buy the 30s, which are going to be in the money. So the purple areas are in the money options right now. Remember, GitLab's trading around 34, right? So this would be $4 in the money. I'll be buying $4 of intrinsic value. So that's one way we could possibly go. That gets us right at a little bit over our limit of 500. But we could also try the 3250, which is also in the money. Now, the benefit of buying an in the money option is you have some intrinsic value built in. The value of the contract will go up a lot faster because of this thing called delta. Delta defines for every dollar that the stock goes up, how much does this option contract goes up. So the higher the delta number that you have here on the option chain, the more you're going to get for each dollar that the stock goes up. So for example, this 3250 call is at a 63 delta right now. So if the stock goes up to 3350, or rather it goes up another dollar, then this contract will go up another 64 cents. So the further out of the money you go, the lower that delta gets. So that's just a quick review on options. So what I would look at is possibly the 3250s here, or maybe even the 35s if I want to give it some room to go and don't want to spend that much. So we're looking at 42 days to expiration. Now, remember, when we're trading options, especially these short-term options, there is a high risk of this going to zero if the trade doesn't go our way, which is why we want to size these properly and not go crazy on the size compared to the size of our account. So that's why I have my 5% limit. I really like to stay within that 1 to 2% limit. So that kind of leans me to the 35 strike, but we would need the stock to continue on up, which we think it will. Remember, our first level is 39. So me taking this $35 strike is not necessarily the worst idea in the world. That gives me a 50 delta for every dollar it goes up. This contract would be another 50 cents. So let's say the stock goes up to 39, right? So which would be another $5 from this 34 level where it currently sits. So that's $4 more. So what we can do is we could, just to kind of guesstimate what this might be worth, is go $4 back in the money. So right now, this stock, looking at the mark, this option contract for the 35 strike in August, are going for right now $2.67. So that's per share. So that's what we would pay, is $267 would be the total amount that we would have to put in. And then if we go $4 in the money, that gets us to, you kind of got to do some reverse math here, kind of the 31. So call it the 30. So this would or could be worth, in theory, $5.80 if we get to the $39 price on the stock, right? So that would be a nice, pretty much double, almost double there of the option contract in a pretty short time, next 42 days, if indeed we get up to the $39 level. So that would be one option, pardon the pun, that we would choose is to buy the $35 call strike. Right now, the mid, and when you're doing this and you set this up, you kind of want to put your limit order at around the mid or in between the mid and the ask. So this is kind of where you would put it. I would probably try it for 275 in this situation. Just kind of lean here to a nice round number, but a little bit higher than the mid. Remember, the market makers need to make money too, so we need to give them a little bit on their side. This is not necessarily the most liquid option chain. If you look at the volume and the open interest here, not a lot of action going on. So that's partly why you need to slide your bid a little bit past the mid price there. So we're looking at that one for 275 on that contract. That would be a $275 investment if you're looking at that for the next 42 days. Let's take a look at the September's, which will give you a lot more time just to compare the two. Remember, so we have 275 for August. Let's look at that same 35 strike for September. We're looking here at a mark of $4.25. So this is quite a bit more, but you are getting a whole nother month to give this stock time to move, right? So we would be looking at a similar situation here. So if we go up to the 30 strike, you see it doesn't, because there's so much time left in the option, it's not necessarily going to move as fast. So you won't necessarily double like you did in August, which is part of why the short-term options are so attractive to people. But if you run out of time, that option will be worthless, and that's the risk you're taking. So you have to balance the time you think it's going to take. And looking at our chart, we think this is a breakout. We think it could move in the next 42 days to our $39, which is our first target, pretty quickly, and then we can see from there how we play it. So that's one trade you could look at, is the long call. So now let's look at a trade. If you're thinking more longer term, if you're thinking to try to play it for that higher $50 level that we showed on the chart, I have another trade here that we need to take a look at as well. Okay, the last trade I'm going to take a look at and share with you here is a strategy we call the poor man's covered call. A covered call is when you would typically buy 100 shares of stock and then turn around and sell a call at a price higher than which you bought the stock. A poor man's covered call is using two options to do that. So we're going to synthetically then buy the stock by going further out, buying a long dated option. So we're going to find a call option that is quite a ways out. In this case, I'm going to go 90 to 120 days out and use that as our replacement for the stock. And I'm going to show you what deltas we're going to choose so that we could get this similar kind of result as if we bought the stock itself. And then we're going to turn around and sell a short call at a price above that so that we could collect some premium, reduce our cost basis, and then see how the trade plays out, right? So let's walk through all of that. So looking at our option chain here, like I said, 90 to 120 days out, that takes us right to October. Looking at December, that's a little too far out for something like this. Remember, GitLab, not a profitable company. We're really just taking this as a short-term trade, right? We're looking 90 days out, right? 1 quarter, see what their results are. We're not gonna try to take this as a long-term thing inside of our portfolio, just given the structure of the company, the fact that they've never been profitable. This for me would be a trade, right? So again, just to remind you, this is not financial advice. This is just me showing you how I would approach this trade. I've already given you 2 ways to play it, one with stock, one with a long call for a smaller account. And now we're going to look at the poor man's covered call. So let me open up the October chain here. And with a poor man's covered call, what we need to do is we need to replicate the 1-for-1 relationship that we get when we buy a stock. So when we buy a stock, if the stock goes up $1, we make $1. If it goes down $1, we lose $1, right? So with options, as I just mentioned before, with the call option, we have this thing called delta, which dictates how much the option contract is worth for every dollar that the stock price itself goes up. So in this case, it's not 1-for-1. If you buy at the money, right, you're going to get about a 56 or 50 delta, which means for every dollar the stock goes up, it's only going to go up 50 cents, right? So what we need to do is go deeper in the money so we get a better delta. A lot of folks like to go anywhere between 70 and 80, so which means we could drop all the way down to $25 as our strike price. We would then pay $11 per share for that, which is indeed a deep discount. It's a third of what the stock is currently trading for. So that is a good way to use less money to get in a very similar position. Now, for every dollar that the stock goes up, we're going to get 82 cents. So we're taking a small little haircut off of that. But look, we're only using a third of the money required to do it. So this is why this is a strategically sound strategy, is that we could use less capital, right, to get into this position while still getting a very similar return as the stock moves in our direction, right? So we could look at the 25, and I'm going to point these out on the chart. So, you know, as trader's choice, you could decide how deep you want to go. Now, I said 70 to 80, which means we could also look at the 30 strike, right? So that one's a little bit cheaper. It's $400 cheaper here. So that's another option that you could choose, is the October 30 or the October 25 strike. Let's take a quick look at the chart and see what that looks like on the chart for both of those strikes. So if we're looking at the chart here, switching over to GitLab, we'll notice that the $30 strike will take us just below our big breakout candle, which, you know, if you're trading the breakout, that might not be a bad place to be. You know, we're going to spend a little bit less to do it, right? About $400 less to do it. But, you know, it doesn't really give you much room for the stock to pull back and bounce and do all of that. So that's the trade-off you're going to make if you pick the 30 strike. Now, the $25 strike, on the other hand, we come all the way down here, and that gets us below this last swing low that we have on the chart, which is also a great place for a stop loss. So, you know, you might want to look at the $25 strike here for that reason. So, and if the stock pulls back to 25, you're just going to maybe close out that trade. You know, when you buy a option, the max you could lose is what you paid for that option. So in this case, we would be risking the $1,100 or the $700 if you bought the $30 strike, right? So $25 strike was going for like $1,150. So that times 100, so that would be $1,100 you're putting at risk. And then the $30 strike was going for $750. So that was $750 you'd be putting at risk there. So you as a trader have to determine, based on your account size, based on your comfortability of the risk, because remember, these things can indeed go to zero. Now, if the stock drops below here and starts closing below the 20-day, or even starts closing below the 50-day moving average, I might consider taking my option off. So that would be my stop. It's not a hard stop on the broker. It's going to be a hard stop on my chart, right? So I would need to monitor this. This is not a set and forget type situation. So you're going to want to pay attention to this and make sure that the stock is not coming back. So if it drops to the $30 level, you know, maybe that's where you start paying very close attention and make sure it doesn't close below any of our moving averages here. So let's switch back on over to the option chain and pick the short strike for our poor man's covered call. We picked the long strike here. Now it's either going to be 30 or 25. I think I'm going to go with the 30 just to kind of let that one play out a little bit and see how it goes. I like being a little bit closer to the money there. All right, back on the option chain now. So we're going to go with October. That's between our 90 and 120 days. December is too far out. September is much too close for the poor man covered call strategy, in my opinion. So we said we're going to try the $30 strike. So we're going to go ahead and select out one to buy it. Now we need to go find a short strike. So for the $30 strike, we're looking at a price of, it's not going to be 820. We don't want to go on the high side there. We're going to probably say, let's say 750. That gets us right just above the mid. That might be a good place to get a fill and get that order actually executed. And then what we're going to do is we're going to find the next expiration. So July is much too close, 7 days too short. It's not going to give us room to put our short call. So I'm going to go select August here, and we've got $7.50 is what we want. So we want to try to get at least 10% credit for this, if not a little bit more. So we're looking at maybe trying to get 75 cents per share if we can on the short side. And looking at the option chain for August, that would put us right around this 67 cents here if we try to do the 42.50. Remember, our upside target was 39, so 40 would be beyond that, and we'd be able to collect $1. So I think that's the strike that I would select here for this poor man's covered call strategy. If I do that, we add that in, that gets us a $10 width. We're then now looking at a price of, with that extra dollar we just collected, we're going to be maybe looking at bidding this for maybe 640 for that entire spread. Now, this is what we'd look at here. So now we're paying $6.40 for a $10 wide spread. So what does this mean? So if the stock gets up to $40 by August 21st, right? What we can then do is we can close this entire thing out. It would be worth actually more than $10, but it would be worth at least $10 at that point. And I know that because what will happen is this particular call here, the long one we bought for October, will now have $10 of it intrinsic value, meaning that it will have $10 more in the stock price if the stock is at or above 40. And then this short call here will then expire, and then we just have to pay the difference to close this out. Now, if it closes below 40, we get to close this out for no money. We get to keep our full dollar. If it's above 40, then we just get to close this out for a much higher price, but the $30 strike that we have here is offsetting any losses that we might get from selling the short call. So we're looking at 640. You know, worst case, we're above the $10 of here for the August call. So then worst case, we could collect 10. So that would be a 50% return on that just in a very short period of time, in a 42-day period. Now, if the stock price gets up to 40, bounces, and in August it closes below 40, we get to sell the September, and we get to select the new strike again, collect more premium, and continue to let this play out. So there is an opportunity here for a very big return on our investment, but now we've also reduced our risk by selling this 40 call. And then maybe if the stock closes around 39 or 40, around August 21st, we would roll up to the 50, which is our ultimate point anyway. And then now we'd be getting in for a lot less than 640. It'd probably be another $1 we collect. So we'd be in for $5 and collecting on a $20 spreads, right? So you're now getting a $20 bill for $5, which would be a very, very, very nice return. All right, now you got 3 ways to play this one. I've given you the first one is to buy the stock, let the stock run up to our targets, manage your profits as we get up there. First target 39, next target 44.50, and the ultimate top target for us on this particular trade is 51.30. Call it $51 level, right? And then the second one is to just buy a long call. We looked at the long call here in September, so you could buy that. It was, I think, $265 for the $35 call. And then the last one was we looked at a poor man's covered call strategy where we bought the October $30 call, and then we sold the August $40 call, giving us a $10 wide spread, and we were going to pay about $625 for that. So that would get us into a nice position where our $40 here would be marked here, and then we could roll that if the price slowly gets up here. If it blows on through there, no big deal. We collect a very quick 25% return. You could always roll that August short call again out to September, all the way out to October, even if you need to get a higher strike price. Just make sure if you do that, you're going to collect a credit to do it. Otherwise, it might not be that fortuitous to try to continue to fight that. All right, I'm the Wall Street Yardie. This has been a good one. GitLab breaking out here. We're going to continue to watch that, see how we want to play it. Good luck on this trade. Let me know in the comments if you took the trade and how it's going. And then let me know if you like to see more trades like this going forward. Don't forget to like, subscribe,